Welcome everyone to our latest live chat. I'm Dennis Stearns, joined here by our co-chief investment officers, PJ Williams and Glenn Joyce. And today we're going to hit on one of the more puzzling things for our clients, and actually many people, which is the relationship of Wall Street and Main Street, and why it appears to a lot of folks that there have been disconnects in Wall Street versus Main Street. And the interesting piece here is that this has been true for decades and decades and decades, that there is a loose relationship. And part of the reason that there's a loose relationship is that our gross domestic product numbers, some of our economic numbers, don't always reflect all pieces of the economy. Another part of this equation is that the stock market, as we've said on many, many occasions, the stock market is not looking for things to go from bad to good. They're looking for things to go from bad to less bad. And history shows that the greatest returns in the stock market are when you go from bad to a little less bad, because by the time you get to actual good and all green flags are flying, the stock market is already up and roaring and off to the races. And so if you wait for that, you will have missed a big chunk of the recovery. This time, some are saying it's different because we have the potential, either due to pandemic issues or other issues, for a double dip recession, or some would say there's parts of the economy certainly still in recession and not recovering quickly. And so there's a lot of interesting differences between this situation and what we had back in 08, 09. We're going to try to tackle some of those things today, including the whole issue around education. And that certainly is a hot potato from an economic viewpoint. We have a lot of clients who are having to do double duty or even triple duty with staying home with kids, or have been doing virtual things with kids and now sending them back to school. And in recent weeks, we have seen that this is not working the way it had really been planned for back to school, and there may be some issues there. As one of my friends likes to say, there are two groups of people who you can be sure will not comply with rules: kindergartners and college students. And so the kindergartner piece, we've had some people who've said, well, they don't seem to be affected as much by COVID, so they'll be fine. Well, the problem is the latest research says they carry as much or maybe even more of the virus around with them to infect their parents or grandparents or others. So this is going to be messy and uneven this fall, and that is probably the theme for today's show, is messy and uneven. So PJ, you want to kick us off into the messy and uneven universe?
Happy to, Dennis. So on this first slide, what we're really looking at is looking around the world at how GDP was affected as a result in Q2 because of COVID and because of the shutdowns that occurred across many countries, and then what the expectations are right now for a rebound to occur during Q3. And you can see that very widely. But the Euro area, especially countries such as Italy, France, and Spain, took the brunt of it, with UK having one of its worst quarters in history in terms of declining growth or contraction. You can see the U.S. sitting there at a negative 9% quarter over quarter reduction in GDP. Again, that 9% is kind of a 1 quarter equivalent to that 35% number that the media has been touting. That's an annualized rate. If we continue at this pace, that is what would occur. That is not the expectation. That would be a much worse situation, and that would be something that the fallout from that is hard to describe. So again, the expectation was that was a 1 quarter hit, and that we are going to see some growth and rebound here in Q3 as the economy at state levels have reopened in many places, and things have gotten going again. Again, it's going to take a while to get back to where we were. This is not a 1 quarter fix, not a 2 quarter fix. It will take a year, maybe more, to get back to where we were on a real GDP basis. And just kind of put in perspective how large these drops are. And again, this is looking at isolated quarters, not annualized. So I want to be clear about that. But we've really, all these countries, we've been taken back in time. If you're looking at what real GDP was in Q2 and when was the last time we experienced that. And so just to put that in perspective, the US, our real GDP went back to the Q4 of 2014. The UK, well back to the beginning of 2004. And then you look at France, Spain, and Italy. Italy went all the way back to Q3 of 1993. When you're looking at the real GDP they produced in Q2 of 2020 and when the last time they experienced that same number. Again, we went back in time really quickly. Same thing's going to happen when, assuming the rebound at Q3 that we're all expecting based on the reopenings occurs, we're going to experience a fast forward. So we're not going to stay at 2014 levels for the US or 1993 levels for Italy. But just to put in perspective how large a drop and shock to the system we experienced in Q2, I think that definitely puts in perspective.
Yeah, and one of the questions that we get a lot, it goes back to the early days of the pandemic and the debate over, is this as Ben Bernanke called it, just a really bad snowstorm that freezes things in place, but then when the snowstorm's over, you have some damage, but you kind of get back to normal? Or is it an F5 hurricane, or is that an F5 tornado? I don't. Anyway, a level 5 major event that not only disrupts things but creates a lot of damage. And what's your sense at this point on that balance of how, pent up demand, how much pent up demand there is, and those kinds of things?
I think the pent-up demand, you're seeing it in certain areas. And again, I think this is going to be the disconnect between different income levels, unfortunately, where you see, Lowe's and other home improvement stores stocks, at or near all-time highs. You see home builder sentiment very strong at levels we haven't seen in 2 decades. And so you're seeing parts of the economy where there's a lot of demand and people are spending money. But then you look at, and we'll look at a chart here in a couple slides where, okay, for the people that have been most affected by the pandemic from an employment perspective, the U.S. government and the $600 a week extra in unemployment benefits carried us for a while, and that allowed payments on everyday needs, and let's say think a rent payment to continue to be made. But July 31st came, there's been no extension, and so you'll see that there's been a sharp drop-off in federal unemployment assistance being paid out. And so I think that's what we're seeing, is that the pent-up demand may be in certain sectors or certain parts of the overall population, but there's still parts of the population where there isn't a pent-up demand because they don't have the necessary means, maybe week to week, to even buy necessities in some aspects. So again, just like we said, the economic recovery is going to be disjointed overall at the individual level, the consumer level. It's going to be disjointed as well.
Hey, Dennis, if I could just add a comment on that. I think the pent-up demand, was traditionally a manufacturing rebound story, right? Where you had, durable goods where that would kind of build up and companies have to come back online and maybe double up their orders to kind of catch up on their backlog of orders when things did improve. But you think about, this is a services-driven economy now, right? And so, you can only go out to eat once. So you can't, some services there's not ability to have pent-up demand, where some services perhaps you can, but I think that's a lot less of a story on a services side equation of the economy.
Yeah, and one of the things that we talked about in our written chat last week was the pivot that is happening to other sectors of the economy. And again, it's a lot of the super trend stuff that we've talked about for years, that the pandemic appears to have maybe accelerated some of that. And so in future chats, we will tackle that big issue. But that's a little bit more like a big iceberg moving through. I mean, Again, there's elements, as we've talked about before, telemedicine and other things that are moving at way faster than iceberg level. But there's other changes and shifts in the economy that are moving slower. So we'll save that for another day. So let's go on.
So over the past couple of months, this seems to be a regular theme. We've been giving updates on the current crisis with COVID. And so one of the key themes that we've continued to reiterate is that we want to focus on hospitalizations and deaths. It's great that we've been able to do more testing, and whether that's led to more cases or what. I mean, that's all debatable on that side. But obviously, the increased testing does have a link and a correlation to the increased number of cases. But what's really important is the hospitalizations. That's what becomes a burden on our healthcare system. And so when we spoke a couple of weeks ago, we saw both the daily cases and the current hospitalizations taking a rise and moving what we thought might be towards the peak. And that is what has happened to date. As you can see, both daily cases and hospitalizations have rolled over and are on the decline for now. Deaths, it looks like they may be peaking, but again, we're still at over 1,000 a day across the U.S. And so again, a very high number. But really, going forward, it's going to be going into the next season. We have fall coming up, which leads to flu season. And so the question of, are these improvements in daily case numbers and current hospitalizations going to be able to continue to trend down? And can we get this to a much lower and sustainable level? And that is obviously TBD. One potential positive going to flu season this year that may negate some of the potential for flu infections to pick up is really the idea that we're all, or many people across the country, because of state and local ordinances, are wearing masks, doing social distancing. Some of the things that in past years during flu season, we're all always told to wash our hands, but there's other measures being implemented this year because of COVID. And so that may potentially be positive for the flu season. But again, this is going to be the continuing crisis. If we see a flare up and you see cases spike and hospitalizations spike after that again, prior to there being a vaccine and or some type of treatment, and you see any local and state governments take steps back to reclose certain parts of the economy, that's again that uneven economic recovery that Dennis talked about.
Well, and I just got a interesting text from one of our audience members who happens to be one of the top infectious disease folks in the country in Southern California. And he said, I get the very weird feeling that when I go out of my home, Americans are done with the virus. But unfortunately, the virus isn't done with America. All right, next slide.
Okay, this I think is an encouraging slide, kind of the silver lining, hopefully. This is looking at just in the past week or past 7 days, the number of cases of COVID-19. And so we talked a lot about the rise in the past month or so in the southern states here in the US, and just the concerning trends there. And I think this slide, once again, it's a short-term slide, and we want to obviously see more data as we go forward. But you can see in green states that are starting to see some decline and starting to see a little bit ebb and going in the right direction, particularly here in North Carolina where we are. So that's very encouraging. But as PJ mentioned, we still have some rising pockets, and you can see those in yellow. And I think, as he also mentioned, what we really want to see is that positive kind of carry through when you start looking at hospitalizations and the survival rates, because obviously that's the key points we want to focus on. And this is very dynamic information coming at us. It's changing, obviously, a very fluid situation, but obviously very, very critical to reopening the economy. So something we're definitely wanting to continue to monitor.
Yeah, and one of the things that I'm suspecting that every one of our audience members has already known about, because the University of North Carolina, Chapel Hill got some recognition that it didn't want in the country as one of the colleges that opened up and then has had to completely change their game plan. And I was talking to a chancellor of another university recently, and he said, well, we knew that students were coming from all over the country, and some of them were coming from hotspots, and that might create a problem. So again, this is one of those that a little bit like the mayors and police chiefs that we heard from who said, everybody should have realized that opening up bars was probably not a good idea. And so, but at the same time, talked to another board member of a major university, and they said, hey, we're plowing ahead, but we have half of our normal student population on campus, and we're following the Denmark approach, which has done a phenomenal job on their education system. So this is going to be interesting to watch over the next month or two or three.
Okay, so this one I think is another encouraging chart, or at least the trend, but obviously there's some uncertainty here. Now we're talking a little more now on unemployment and kind of the labor market, and obviously that's very critical to us kind of reopening and getting that consumer spending back going, which obviously is the lifeblood of the economy. And so here we know that we've kind of seen some positive trends. I think the unemployment rate currently, the headline rate, is around 10.2%, which would about cut it in half roughly from where we were at the peak. And but the problem is the underemployment rate. You may have heard of this U6 rate, which kind of looks at people that aren't working at full capacity. That's still close to 17% almost. So that's still concerning. And obviously, as we look forward, we're trying to think about, what's around the corner. And you can see these charts give us a little bit of preview of kind of where we've been headed. And kind of, if you look on the left side of the equation here, you look at the unemployment insurance. So the trend there is very positive in terms of the claims. People sign up for unemployment insurance. And we see we're still kind of had a little bit of an uptick at the very bottom there, right, or we went back above 1 million folks. But obviously, very, very good trends there. Now, as you shift over to the middle pane, here's where we get into the benefits. And we know that now we're kind of sunsetting now on the benefits for people who need this bridge to kind of get to the other side of this abyss that we're looking across. And so ball's back in Congress court. We got to figure out, is this stimulus coming? And I think it is. It's just a matter of, we've got to get this resolved and quickly to focus on getting people the money they need basically to kind of have that bridge to get through this. And if you look at the last slide, you can see we still have quite a few folks still getting unemployment benefits, 15 million folks. And so they're continuing to get, even though we have all this improvement. I think back during the Great Recession, just to give you some comparison points, we thought the Great Recession was bad, right? I think we had around 6 to 7 million at that time, was up near the range at the peak. And also, I think their highest unemployment rate was around 10.6%. So we're just back kind of to that level in unemployment rate and still having to kind of figure this thing out as we try to reopen the economy. And as Dennis and PJ both mentioned, this is going to be, this next phase of trying to reopen the economy, and it's just so uneven. You got certain industries that are more socially dependent that are still trying to open up, like you mentioned, restaurants, movie theaters, the airlines, things that require people being in close proximity. And so it's going to be, it's going to be a very nuanced recovery, and it's going to be something that there may be some fits and starts. But I think we just got to continue to see progress is the key, and just recognize it's more about the trend, and just continue to focus on, where we are and where we're going. So.
And those of you who have watched some of our previous live chats may remember about 3 months ago, we actually had the chart out into the future where we had the baseline recovery, and then we had 3 lines drawn above and on it and below it, and that is playing out big time. And again, this could go down as one of the most uneven recoveries in history. Every recovery from a recession, for different reasons for the recession, has been uneven. This one has some unique aspects to it. Okay, next slide.
Here's a very interesting slide on sentiment. This is more focused on the consumer. I think somebody earlier mentioned, or we've been talking a lot about Main Street versus, Wall Street, and how, Wall Street, the market has been much more excited or rosy on the prospects of recovery, thinking things will get better. And we definitely seen that with the market performance. Here, though, we're talking about more the consumer, so a little more focus on probably, looking at more Main Street focus. And if you look at the left side, we're talking about just sentiment. And even though we've had that strong recovery in the markets, and even though market optimism may be getting, very more enthusiastic, we haven't seen that when we just look at the general consumer sentiment. So we haven't seen that at all. And what's maybe even a little more discouraging is when you think about expectations as you shift over to the right chart, the expectations haven't gotten any better either. So, that's really, I think, more of the reality of what people are seeing in the economy. Given the economy still got a lot of uncertainty, there's a lot of fear. As we talked about, depending on where you are, you could be really in a tough bind right now, given what industries and what sectors you're in. So I think, we're trying to see if this number or these trends will improve. And obviously that gets back to the reopening and some of these COVID cases and the rates we were just discussing. So very, very much something we want to continue to look at and something that we'd love to see some improvement on.
Yeah, and again, as we talked about a lot when we went over our the Factfulness Trends newsletter and some of the special reports that came out of that a few years ago, it is always dangerous to take only one or two data points. And so another data point that maybe starts to tee up this Wall Street, Main Street piece is that the so-called surprise index, the ability of Wall Street or companies within the stock market to surprise on the upside because expectations are so low, is hitting all-time highs. And so again, it goes back to Wall Street or the stock market, however you want to look at it, reacts more to going from bad to a little less bad as opposed to bad all the way over to good. Next slide.
So on this chart, what we're looking at is two different lines. We have the blue dotted line, and that's looking at the S&P performance. So using the right-hand scale. And so we know that the S&P peaked back in mid-February. We hit the bottom on March 23rd. We've had a strong recovery. And this week, we actually hit new all-time highs. And so that's what we're looking at, the blue dotted line. And so the dark blue line is looking at analyst estimates for calendar year 2020 earnings per share. And so once COVID hit, analysts repriced and reevaluated company prospects and company earnings potentials for this year. And you can see the steep decline going from an expected almost $180 a share down to just under $130 a share. So a sharp reduction in expectations for earnings across the S&P. As we've moved forward, the last month and a half, you've seen a slight increase. But again, earnings expectations for 2020 are well below where they were coming into this year. If we had the chart looking out to 2021, and again, FactSet's aggregating analyst expectations across the street, you'd see that the number was up in the mid 190s for 2021, and we're now down to just under 170 for calendar year 2021. So again, below estimates for 2020. And so again, for this recovery on the market side to be sustained, we're really going to need to see some strong upward momentum in earnings, actual earnings, but also earnings expectations over the coming really 12 to 24 months to again justify these prices. With where earnings are expected to come in, many price to earnings ratios are going to be much higher than they've been over the past decade. Again, there are reasons that higher PE ratios may be sustainable in the current market, with one item being the low yield environment. When your 10-year treasury is trading at less than 0.7%, as an investor, you might look at, I might be willing to pay a little bit more for a stock with the hope that they can get their earnings growing and looking out to the future. Again, in the long term, when you're buying a stock, you're buying a future stream of earnings that company produces. So again, right now on this slide, we can see again that the detachment between the current reality of earnings in 2020 and where the market expects earnings to be going a few years out. Again, these will at some point begin to merge. And the question is, do earnings and the economy overall pick up and begin to close that gap? Or do we have some type of contraction in the broader market or in certain parts of the broader market, depending on what sectors are being affected by whatever's going on in the world at that time? We know that back And during when COVID first hit in March, leisure and travel, those sectors took it on the chin. Coming out of that, the rebound we've seen, obviously the companies like an Amazon, like a Microsoft and Apple do very well, along with home builder stocks and home improvement stocks. So again, continues to be uneven, and we will continue to see that as we move forward the rest of 2020, but also into 2021.
Yeah, and so one question that just popped up is the question about the elections and the impact of corporate tax reform or changing corporate taxes in 2021 might have on that $170 figure you mentioned, PJ. And we had this actually in one of our chats about a month ago. We had a forecast for that was suggesting that 170 could go down to 150 if the corporate tax law were changed. But there's quite a bit of information that's been flowing our way that suggests that it won't all happen in 2021. So first of all, this assumes that the Democrats take control of all three branches of government and tax laws are changed in 2021. That is not a fait accompli at this point, particularly the Senate piece of the equation. But even if that happens, it is entirely possible and maybe even probable they're going to spread that out over a few years so that you don't just get one big hit of 170 going to 150. So that's something that we need to keep a close eye on in terms of the perception of what reality might be and the reality itself.
Okay, this next chart is focusing more on inflation trends. And so what we have here are two different measures. We have the 10-year Treasury nominal yield, which is in yellow. That's the top line. And you can see that's been trending down about 0.64% is kind of where we are currently. And then you look at the 10-year real yield in blue, or kind of bluish purple, and that's when you subtract inflation from the nominal, the yellow line. And the difference or the gap there is what we call the break-even rate, which is really just the market's expectation of where inflation's headed, given the difference. And so you can kind of see if you subtract the 0.64 from the negative 0.99, the market's kind of expecting right now roughly about 1.6, 1.63% is kind of that inflation expectation. And it has been coming up a little bit because you can see those two lines have been separating a little bit. And so what it does really reinforce to us is that once again, you're getting low yields as a starting point. And then you kind of got to figure where's inflation, and that could actually make it where you get like a negative return from a purchasing power perspective, which is obviously not good over time, and something we obviously want to try to eliminate and avoid if all possible. I think if you just think about where we are with what's things happened more in the last year, we have seen the U.S. dollar decline, which obviously is another thing that's inflationary when we see the dollar weaken, and that's why we've seen some of these precious metals rise, or at least a good part of the reason. It's part of the reason we've seen gold surge so much this year, not only being a safe haven, but also seeing just that dollar weakness. So I think as you look forward, the Federal Reserve has that 2% annual target for inflation. So we are below that. And what's key right now is there's a difference between the headline number versus the core number. The core number subtracts out energy and food, which are two volatile pieces of the inflation number. And I think we've seen energy obviously weaken quite a bit. And that's kind of where you saw a little bit of spike back in February where it went up and then went right back down and energy prices really, really weakened. Food's been volatile, been up a little more lately. But all said, we're around about that 1.6 is a good number for the core number, but the headline number has been closer to 1 lately, at least in July. So I think the Fed's going to be very, very patient in terms of the Federal Reserve. That 2% target, I would expect them to let that number go above 2, and they'd want to see it stay above 2, and they'd probably be happy right now to see some inflation. Now, the worst case would be if we got inflation and didn't get the economic growth to go with it, and that's like called stagflation. That's what happened in the 1970s. We want to avoid that at all costs. But I think really we would like to see some inflation. That would definitely be a positive as long as the economy is moving forward.
So yeah, this is a classic debate going back decades and decades about what causes inflation versus deflation, which one's more dangerous. And there are some, this time is different things big time. So again, the classical folks today are arguing, well, we have to have inflation because, first of all, the government wants to create more inflation. Now, this presupposes that the sun rises and sets in Washington, D.C. And as we all know, while the 24/7 media may believe that, the reality is that the world at large is causing rates to go up and down and other things to happen outside of Washington. But they believe that the government wants inflation in the future so that they can pay back deficits at a lower cost. So there's that element. There's the element of just the tremendous shift that's happened during the pandemic. Now, again, as we've reported out,
Oops.
We'll pick up from Dennis. Obviously, some technical difficulties there. Apologize for that. But again, like Dennis said, it is the debate. Is this time different? With where interest rates are, with what's going on in the economy, where does that lead inflation? Again, this may be different from the period that we've seen before, where at that point we had back in the 70s we had a sharp rise in inflation, and at the end of the day, the Federal Reserve and Volcker came in and they made sure to try to end that time period by increasing rates, knowing that there was potential that could cause a hiccup in the economy, but they felt that was better than allowing that to go on. So again, we will continue to monitor this over the coming months and years as, again, the balance sheet of the Federal Reserve has expanded sharply. We've printed a lot of dollars this year. And it's most likely we will continue on that path, especially until we get through this current economic and healthcare crisis. But the debate will continue on.
Yeah, PJ, I would just add, yeah, I think you're right on. I think, and Dennis was kind of alluding to it when we lost him, just this pick back up or this reopening, we could see some spikes in certain sectors. Part of it could be that pent-up demand piece. And I think we just got to be aware that the numbers will be very volatile short term. And obviously we want to focus on the longer term trend. And we also talk about globalization. That's been a very, very disinflationary force. And obviously that's kind of changed a little bit. We've been seeing more countries hunker down, protect their home turf. And that's more de-globalization a little bit here more in the last few years. So all those factors play into this. And it's something that we'll definitely be looking at closely, but it's a very fluid situation for sure.
Yeah, and I'm back. Obviously, technology created a problem, although some of you may say that the last half of the discussion, maybe there was elements of our government that wanted me cut off, if you're really paranoid. The last thing that I was going to mention on inflation versus deflation is what we had reported out early in one of our chats. And that is that it's one thing if you take all this stimulus and put it on top of an already robust economic recovery. It's yet another thing if, let's say you go to the lake and 30% of the water in the lake has gone away and you're refilling the lake. There is less chance of inflation. And to a certain degree, we are refilling the lake with demand over the next year or two. So again, I think Glenn's comment, this is something we're going to have to keep an eye on. And in the old days, we would, individual stocks, US stocks, international stocks, anything that had a stock component would be an inflation hedge. Today, that is not as direct a correlation because consumers have more power than ever. And you can see this from the Amazon effect. Originally, it was the Walmart effect and keeping prices lower. And that disintermediation is happening throughout our economy. Most of us only see it in the consumer side, but it's happening in the business to business side. It's happening in a lot of other areas. So again, that's a component that suggests that we ought to have multiple defenses against inflation if we actually start to believe it's going to become a bigger problem.
So on this slide, this is put together by KPMG. We're looking at corporate bankruptcies going back to the mid 2000s on a monthly basis. And so you can see the last couple months, not surprising that we have had an increase in corporate bankruptcies. July of this year, we hit 32, which was pretty much on par with March of 2009 when there was 33. If you recall, March of 2009 was the bottom for the market during the Great Recession. And so the question again is, is the economic recovery going to be strong enough in the next couple of months to prevent this number either being sustained and we continue to see a drip and drabble of new bankruptcies, or can we, hit an inflection point and get this number back down? I think we're all aware of mainly it's hitting certain sectors, retail and energy being the two main ones. Valaris, which is a UK-based company that's the owner of the most offshore rigs around the world, they announced this week that they filed for bankruptcy. Not surprising here in the U.S., many of long enduring brand names have been lost this year or have filed bankruptcy this year. We don't know yet if they'll be lost. But you look at a Lord & Taylor, a Neiman Marcus, JCPenney, Brooks Brothers, the list goes on, unfortunately. And again, that is somewhat the Amazon effect, somewhat, again, driven by the consumer and maybe where the losses have been on the job side in terms of where people are going to be able to spend their money. But again, this is something that we'll need to continue to watch, because while we're on this chart, we're looking at corporate bankruptcies, we're beginning to see that delinquencies and loan payments, whether that be rent payments, mortgages, car payments, are definitely increasing. Again, mostly among maybe the lower income Class C apartments, especially, we've seen a sharp drop in rent collections because, again, we've seen the federal government assistance be reduced here in the last couple of weeks without a plan for what that next stimulus may look like. And we're in that abyss that Glenn mentioned, and we got to find a way to bridge the gap for them in terms of being able to continue to hopefully make payments and, again, put all the essentials on the table for their families. But again, I think we've made this very clear today. We are not out of the woods yet as an overall economy, and especially, unfortunately, for certain parts of our population.
Yeah, and I think there's a perception that on the front of who's at most risk, that it's the roughly 10% of the population that represents a lot of those working population that represents a lot of those unemployed and underemployed right now, and particularly the destruction of the gig economy, which had become a fairly robust piece that was completely under the radar for the most part of normal economics. And that has been dismantled by the pandemic to a large extent. And then there's a perception that, okay, maybe that other 90% are fine. And the reality is, okay, maybe 50% of the 90% are fine and their jobs are secure and they can telecommute. But there's kind of a chewy middle here, and maybe more than a middle, that are experiencing some salary cuts by their employers. Their job is maybe on the bubble, and maybe it's not because of the pandemic, maybe it's because of accelerating use of technology. There's just a whole variety of things going on here. So again, we will continue to track and report out on some of those as the year unfolds. So bring us home. I guess we've talked more about Main Street and how Main Street has got some bright spots and some dark spots and lots of spots in between. Now we're getting to Wall Street and the stock area.
Yes, I'll take the first three and then toss it to PJ to wrap up. And I think the first three are very related. You asked that question, how can the market continue to advance in the face of all this economic uncertainty and this conundrum? People are seeing this disconnect. And I think it really gets back, and I think everybody's I know we've underestimated the power of this, but it gets back to, when the Federal Reserve and when the government, when we're throwing all this stimulus, when you have quantitative easing, low interest rates on behalf of the Fed, and then these stimulus checks and support for the economy and the folks from the government, those tend to be a recipe for good success. Now, it is a very uncertain time, so once again, we probably underestimated that this continues to work even in this environment. But it's something where you think about what happens there when the Fed keeps rates very low, when they buy assets. They're encouraging investment, they're encouraging spending. For one thing, the interest rates are so low, you have to make a pretty strong commitment to stay in cash and not get much, if anything, in terms of return. And oh, by the way, lose out, the purchasing power over the longer haul if you stay in that space. So it does encourage you to look for ways to get a better return. So it encourages some risk taking, to be candid. And I think we've seen that from the market perspective. I think the market feels like the Fed, the governments all around the world have the markets back and are going to continue to support us to get us through this period. And so that's been very positive, and it's definitely been impacting the market sentiment being more positive. So I think those are just, obviously things we want to see continue. And that gets us to the third bullet point. When you think about now that we're kind of getting to the end, the sunset on the first stimulus, at least for people relying on the unemployment, we definitely need to see Congress step up. And, we're having these short-term versus longer-term, kind of tug of war, because we know our debt and our economic health is deteriorating because we're adding more debt. It's a longer-term issue, right? And we got all the things we talk about politically, which is obviously a hot potato. But you look at, if the economic growth can improve, that would improve that ratio. And that's what we're hoping will happen over time, is that the growth profile picks up and makes that debt piece become a smaller component. But the concern is that we don't see the economic growth pick up enough, and we keep adding more stimulus. So it's incumbent on us to get through this, and for these sectors to reopen. But we obviously got to do it safely. But I think that's kind of where we are now. We're waiting on Congress to come back with this next stimulus and see if we can maintain this momentum that we've had in the markets.
And beyond the liquidity injections and what Glenn talked about with low interest rates and stimulus coming out of from both the Fed and from Congress, we also have, and we discussed this on our last live chat, the largest names in the S&P 500, the Amazon, Apple, Microsoft, Google, throw in Facebook, they are performing very differently than the broader market. And they, again, with the S&P 500 being a market cap weighted index, when the largest names do well, they can offset the 100, 200 plus names that are not, 300 names that are not doing well. The median company in the S&P 500 is still down on the year, down, I believe, around 10 to 15% on the year if you look at the median company in the S&P. So again, certain sectors, energy, financials, have not recovered and are still struggling from a performance perspective. So again, one reason the market's doing well is that the largest names are, and the concentrations that are doing very well.
Yeah, but that's an important point, PJ, because, I've heard people say, oh, we're in for really bad times because the stock market is at record highs. But what you just said is the key point. The stock market itself may be at record highs, but the vast majority of companies are still reflecting the pandemic. And it's really these big tech names that have driven it up. So it's largely an illusion that the stock market is dangerous. Now, again, you can argue, and we've been talking about the pros and cons of the techno-industrial revolution, whether Facebook and Apple and some of those are in danger at this point. But the large percentage of stocks are still reflecting the pandemic, right?
Yep.
Yep.
Two other things, again, that are kind of separating maybe Wall Street from Main Street are we are seeing in certain parts of the market better economic data, and Dennis talked about this, whether it be something like the City Economic Surprise Index, home builder sentiments from surveys that they're given. There are some pockets of strength that are showing that things are getting better. And again, going from terrible to less terrible is very positive for the markets usually in terms of how it's received. And then the last one, again, we've seen this on a regular basis, and we all hope that it becomes a reality sooner than expected. But we all have to be realistic at the same time, is that a vaccine and or treatment will get cleared by the FDA. Again, we continue to hear about progress, different stages of clinical trials. But again, until we get that firm evidence that there is a vaccine and or treatment that's been approved that can be mass produced, again, that hope is going to still be out there. And I think many expect it, whether that's, Goldman Sachs, I believe, thinks by the end of 2020 we'll have that vaccine, with it being mass produced sometime during 2021. Again, a lot of time between now and then to see if any of the pharmaceutical companies working on this, biotech companies, can get across that finish line and get something approved.
Well, and so we have an interesting question here from our audience around, and I'm going to try to paraphrase this. So we've talked on this chat about the impact of Federal Reserve policy and the massive stimulus and how that is a big part of the equation. We've also talked about the hope and expectations for vaccine and or treatments, but we've also talked about the fact that we've got several things in between the longer term and the short term, including an election and including the possibility this fall of things not trending in a good way for the pandemic. So how do you balance an investment strategy? That's the crux of this question when you have all these cross currents going on.
Yeah, I think it's definitely becoming very important about, from an investment standpoint, about where you're invested, because as we discussed, there's certain sectors that have been accentuated and are thriving, you could say, technology obviously being the poster child for that. Other areas that are more, tied to consumers coming out, spending, and just more of that social interaction have not, and more, you think about essential folks that are out there, that are trying to get through this. So I think, really trying to, it probably still gets back to looking at everything we normally look at in terms of valuations and growth projections and kind of where things are trending with earnings. But it's obviously a very fluid situation. And it's interesting, a lot of the companies that were offering guidance this quarter, it turned out to be maybe a little bit better than expected quarter, given expectations are pretty low for the second quarter. But not many firms were guiding past the quarter. Everybody was playing it very close to the vest. They were afraid to give much in terms of longer term, estimates and guidance. And so that is very tricky, I think, it's becoming more and more critical where you're invested. And we are seeing some opportunities in certain areas, but they tend to be in areas that have a lot more risk. And maybe you could say the risk isn't as much because they've already been, beaten down in some sectors, whether it's industrials, financials haven't recovered as much. Those are areas we're continuing to investigate. We already got some exposure there. And matter of fact, industrials was an area we had a little bit extra. But the technology has been tough to leave. We've been trimming it back some. And I think it's going to continue to be a very big focus on kind of positioning beyond just being focused on the broader indices.
Okay. We have another, and I think this is going to need to be our last question from our audience. Can you talk about the now more likely K recovery? So we started out with V shape versus U shape versus W versus square root. Now we got a K recovery, and where the middle class lies in that. So that is a really interesting question.
And I think a lot of it continues to be based on the path of the healthcare recovery and then the economic recovery, because the longer this goes on, and if the corporations do not continue to receive some type of, we'll call it support, bailout, whatever you might call it, you will begin to see, I think, a change in where the layoffs begin to occur. You've heard some of the large banks around the world have announced layoffs that will broadly affect, I'd say, middle, upper class. Again, if you see that in other industries, given the duration and the fact that at some point the companies can't sustain the labor cost on their balance sheet, that's where you can start to see the middle class, I think, get hit hard. Again, we talked about before the great financial crisis, the job losses seem to be spread out across upper, middle, lower, depending on what sector you're in. If you're in the financial sector, you got hit really hard. This one, the early part, the first stage has been concentrated in more of the services sector and more, I'd say, lower to maybe middle income. But again, if this continues, it's likely that the job layoffs will tick up into the middle class and the upper class if companies can't get past this quick enough, and or they can't find either funding from traditional financing from banks and or bailouts from the government.
I think I would just add, I guess the way I look at this, I think the coronavirus, the pandemic, it's created more disparity, I believe, because you do have people that if they have investments, they have savings, they've been in the market, they've benefited at least on this recovery piece, this rebound, and so that's given them more optimism. If they've been able to keep their jobs, they've been in areas where they're able to continue working. That's probably been good for them, obviously. And the people that don't, have empathy. I feel grateful and blessed we've been able to keep working, but it just probably has created more of a gap. And I think that's where you want this stimulus and these benefits to go to the folks that really need it to get through this, and the ones that are in the most peril right now. Don't have any easy answers here, but I recognize that the disparity probably has grown as we've gone through this.
And as we have talked about in many of our trends reports, the super trends, which again tend to get forgotten in the middle of crises, continue to grind on. And so one of those super trends that we've talked about a lot in the last few years in our newsletters is the fact that if your job is subject to certainly going away via automation or robotics or anything like that, you're in danger. But also just the ability to be indispensable in an organization. And that is probably the number one thing that we talk to people when we're talking about their careers or their business in a pandemic endgame and post-COVID situation is how indispensable are you? And if you can't answer that question with a high degree of confidence, now is probably exactly the time to be figuring out how to up the game. And we actually have a lot of clients. In fact, we talked to 3 of them this week with closely held businesses that are doing exactly that. They are upping their game. We also have several folks in the medical profession who are trying to figure out where things are going to be post-COVID and trying to up their game and taking specialized courses and things. And it's tough because everybody's in a high stress situation. And again, going full circle back to the education piece, particularly if you have younger children at home or immune systems that are more compromised or a whole host of things, it's tougher to lean in this scenario. So again, we would recommend that everyone, to the extent they can, make sure you're indispensable for the next stage of whatever is ahead of us. So on behalf of PJ and Glenn and Stearns Financial, we appreciate you tuning in today. Again, keep your cards and letters coming. We feature a lot of your frequently asked questions in our written chats, and we also archive them for the future. And this has been recorded, so it will be available on our YouTube channel. So in the meantime, have a great Friday and a great weekend, and stay safe, everyone.